Hello and welcome to this Foresight webinar. My name is Bruce Whitfield, and today on behalf of Fortress REIT we are going to be looking at property opportunities, particularly in retail and logistics in Central and Eastern Europe. A huge opportunity presenting itself in a region which is gradually returning to some kind of normality following COVID-19, or at least we hope we're going to a post-COVID-19 world. It has been a really difficult 18 months. Well, today we kick off the Fortress REIT Chief Executive, Stephen Brown. He'll catch up with us in a moment and give us a brief introduction and talk to us more about those opportunities in Eastern Europe. Your keynote today with FNB property economist John Luce. We'll give him 15 minutes. You've got to contain him because he does go on a bit because he knows a lot about the property sector and he is particularly excited about the logistics opportunity. Then a regional property panel with experts from Central and Eastern Europe. They have got lots of strong views, which you will enjoy today. And you can also keep up to date by following this discussion and following us on LinkedIn. And that, of course, is the Fortress REIT LinkedIn profile. And never before, when you look at LinkedIn, never before have warehouses built on empty patches of land seemed so sexy. And not, they're lovely buildings and everything, but it's about the returns. It's about the returns. First up, Stephen Brown, Chief Executive at Fortress REIT. Stephen, over to you.
Thank you very much, Bruce. We really appreciate you hosting our webinar yet again. I think it's a very appropriate time to talk about diversification, and certainly the diversification that we've seen Fortress do, which is really into Central and Eastern Europe. And I think that's the topic for our webinar today, called the Property Frontier. It's been a long, hard winter here at the southern tip of Africa. We've seen the third wave of COVID, which hopefully is now past its peak. And 2 weeks ago, we saw riots and looting, civil unrest like we haven't seen in decades in this country. And I think while we are certainly a very proudly South African company, and we will rebuild all of the assets, all of our approximately 7 assets that were damaged, I think it does bring to the fore the need for companies to look at a bit of global diversification. And I think what that does is it balances the Fortress portfolio. We certainly aren't exiting South Africa by any means. In fact, it would be a rather silly time to exit, being at such a low. We are very optimistic about the future. And I think, as you've seen, the current leadership under President Ramaphosa, he's made some very positive changes and will continue to do the right thing in our view. So I think right now we are committed to rolling out our development pipeline and looking after our core assets in SA. But added to that, what we see in Central and Eastern Europe is that it's really a fantastic time to be investing in real estate there. I think real estate works nicely when you're at the end of the development phase of a country. You need land tenure, you need court systems to work, you need bank and capital markets to be able to provide you the debt. And I think something that we bring, which is the risk capital to those countries, really does provide nice runway. I think, as you'll see, a lot of our panelists today talking about the nearshoring into the EU. It's a country that we're focused on, is all of the periphery countries to the EU, the new joiners such as Romania and Poland, where there's a lot of positive tailwinds in the real estate industry. I think you'll see our panelists certainly talking about it. Thanks very much to Alex Mora, who's really been at NEPI for a long time and positioned that business, in which we have a 23% stake, into a really solid Central and Eastern European platform. Our very own Maciej Judiński, who's our managing director of Fortress, Irina, who runs Investment Report, and Brian Jardine, who's also been in Romania, focused there for about 15 years or so. Thanks again to Robert Dubrovsky, who's contributed. Thanks very much to Fulga and to Dennis for their insights. And then our keynote address, John Luce, who can certainly give you a little bit more insight into how he's seeing the macro picture in South Africa and how he sees our future over the short to medium term. Thank you very much for joining us today, and we hope you enjoy our webinar.
Stephen, thank you very much indeed. Thought-provoking views from you to get us kick-started today, but lots more views coming and lots more perspectives and lots more experiences from people who live in the region, work in the region, are tourists to the region as they call themselves. So getting some great insights into property opportunities, particularly in retail and in logistics in Central and Eastern Europe.
Central Europe is and was always special as it was underdeveloped compared to Western Europe. So, and it is a supplier of Western Europe, supplier of Germany. So we have probably in Central Europe a double positive effect, which is supply and moving from Western Europe to Central Europe of businesses, of occupiers. And the second thing is obviously current growth in e-commerce locally, but also internationally. Before, Central Europe was a service provider production-wise.
I've always believed that. I was a very big believer in the Central Eastern European real estate market, and I've been doing this business for a long time. Why do I think that? It's because these are markets that are not oversaturated. The product that can be found can still be very, very good. The yield levels provide returns that can be very pleasing for investors. The quality of the personnel and of the people that you find in these countries in terms of training and education are extremely good, and that's why more and more businesses are opening in these countries.
We have been investors in the Southeastern European markets since 2005. We know them quite well, and we have enjoyed the upside that the markets have enjoyed during the last 15 years. We still have a very positive outlook of these markets for the same reason that we came here. In the first place, the Central European and Southeastern European markets continue to benefit from region-specific and country-specific positive macro and other factors. In terms of macro, we expect them to grow at an average GDP rate that exceeds that of other Western countries. They have grown by 115% in the last 15 years, since 2004. And McKinsey expects the region to grow by another 200 billion by 2025. Since 2004, they have closed the gap to Western European countries, which started at 60% and it dropped to 31%. And they continue to grow at an average rate of more than 3 times of Western countries.
We're seeing consumers going to stores, we're seeing increased business and consumer confidence, and you just have to look at the Euro 2020 football championship to see that things are more active in the region. It is true that we're seeing a cyclical recovery across the whole world, but what is more exciting about CE are the secular growth recovery that we're seeing from 2022 and beyond. We believe that CE will outperform the rest of the world for the coming years, and it's driven by a few factors. The first point is that CE is strategically located close to the border of Germany, which is a large manufacturing hub. But it's also the bridge between highly productive Asian economies and rich Western European economies. The second factor is that CE has a highly educated yet relatively cheap labor force. And this means we build warehouses cheaper, we run shopping centers cheaper, and people are able to get more value from a highly educated workforce than we see in Western Europe. The third point talks to how CE is rapidly changing and diversifying the economy. Historically, CE was predominantly a manufacturing hub with the auto sector dominating the region. These days we're seeing a lot more services and tech-related industries, and this is becoming more exciting for the long-term growth of the region. The fourth factor is the rising local consumption. We're seeing consumption demand increase by over 5% in the region, and this compares to lower growth in South Africa, which is normalizing back down to below 2% by 2022.
Going forward, I truly see growth coming in the next 2 years from all the areas of real estate, especially since the very recent evolution of the construction prices. So I believe that the good products available on the market will definitely have an advantage because of this impact in the construction prices. But to be more specific, I truly believe that the retail sector in general, will witness the highest growth. And out of this, the retail parks. These parks have proven to be a very good investment, especially during the COVID times where you had to obey certain restrictions, but also they are a very resilient crisis investment as they focus on quite lower rents, big traffic numbers, and mainly discounters. So they are very attractive for the larger population. So I believe that we will witness the highest growth in this field.
So overall, yes, we're very positive on Southeastern and Central European real estate. Some segments are more attractive than others. Logistics, for example, have had a really good run. Residential remains very attractive. At the same time, I think the overall real estate market has very positive fundamentals, good value and good yields, and we can get involved further over the next 5 to 10 years.
So overall, very positive outlook, and logistics is the theme right now going forward. Central Europe will grow, and the market being small in terms of stock, is growing, and that's going to stabilize the market from the supply-demand shocks, and also should influence positively rental values over a longer period of time.
Thanks, everybody. And on to John Luce now. John Luce is a fixture of the South African property sector. You see the property link right there? Fixture? Anyway, John Luce is the FNB commercial property expert. He's an economist in the property sector. It's a sector that he's been looking at for close on a quarter of a century. When he's not riding his bicycle, he's thinking property, and probably then as well. John Luce, welcome. Nice to have you with us. Your keynote, please, sir.
I think when one talks about balancing your portfolio of property and where to invest and how to diversify, I think it's important to park the shorter term fundamentals of property and look at the longer run fundamentals of the economy and of property, because at the end of the day, property investment is a long-term game. I talk about the super cycle, the economic super cycle, of which there have been very few in my lifetime. And to go back to the last big super cycle in economic growth, I go back to the 1970s, 80s, all the way to the early 90s, ignoring a very short-lived gold boom in between. The South African economy had some glory years growth-wise in the 1960s, and then through the 70s and the 80s, it stagnated. First driven by a global economy that was off the boil, and later on by increasing boycotts and sanctions and isolation due to the previous political system. It got to a stage where we were in and out of recessions during the 1980s, and a particularly volatile period set in, not only economically, but politically as well. There was a lack of economic growth, and with that comes in that stagnation phase of the super cycle, comes anger. You could see it in strike action, you could see it in protest action, unrest-related incidents during those days. And I believe that weakness in the economy and the mounting anger, which was in big part driven by that, ultimately brought about radical political change as we knew it in the early 1990s. When I say radical political change, I believe was change for the better, but we got through it, and eventually it turned out well in 1994 with the first democratic elections, and then we went into a good period. Economic boycotts and sanctions were uplifted. And later on, we realized we didn't need those astronomically high interest rates. We cut them quite aggressively in the late 1990s and into early the 2000s. And that brought about a massive consumer boom. And it brought about a massive housing boom and commercial property boom and 5% plus GDP growth. That's what I refer to as the supercycle upswing phase. But during that time, property values across the board, most notably residential and retail, in real terms from the mid-90s all the way to 2008 odd, rose very significantly, and property became relatively expensive by our historic standards. We've since run out of stimulus ammunition. We've pulled the interest rate lever quite hard. We've cranked up the household debt, cranked up the corporate debt, and more recently cranked up government debt as well to try and keep the economic growth party going. But unfortunately, we've neglected our structural issues. We haven't invested in infrastructure meaningfully since about the late 1970s, early 1980s. Skills development lacks. There's a whole lot of well-documented structural problems which drag us down now that that easy stimulus of the boom years has been shot out. And so we go back into the supercycle stagnation phase. We've been in there for the past decade or so since the global financial crisis. The economy's never quite been the same again. And there's not a lot we can do about it except get down to the hard work of fixing. The Ramaphosa administration has acknowledged the need for structural reforms that us economists talk about. So we're in the supercycle stagnation phase yet again. It's brought about clear signs of heightened tensions and heightened anger over the past decade. We've seen that in the strike action numbers. We've seen it in service delivery protest numbers, in unrest-related incidents. The most recent spate of violence, most notably in KZN and Gauteng, taking it to a different level, but certainly nothing new. It's been a decade of escalating anger. So we're moving into a volatile period yet again. Political tensions rise, big political battles playing out within the ruling party and ruling alliance, and it's going to be a period of great uncertainty until these battles are won. For structural reform, it's not that easy. You don't just get with the stroke of a pen the structural reforms you need, as some people might think. It's firstly the hard political battles that have to be fought. Because what one must remember is every time you reform, you're changing. You're changing from the policy direction and situation where you've been. And ultimately, someone's going to lose out to those reforms. They're not going to be beneficiaries of the new dispensation. And so they will not go down without a fight, be it a political faction that's losing its grip on power in the ruling party, or be it unionized labor in a parastatal that desperately needs reform and restructuring so that it can perform better. So there's this whole load of political and policy battles that have to be fought. It's possibly our Margaret Thatcher time. If you look at Margaret Thatcher's era in Britain in the early 80s, she needed to privatize the mines. The nationalized mines were loss-making and costing the taxpayer a fortune and unsustainable. And she had to fight those battles, take them on, let them blink first, show the political will, and follow through despite often quite significant disruption and destabilization. And that's the era we're into here. It's our Margaret Thatcher moment. That's probably the best way to put it. And government has to show the political will to force through ultimately positive structural reforms. But that's probably some years away before we see the benefits of that. So in the meantime, stagnant economy, volatile economy, great uncertainty, and with it, property market correction phase. That's not the great time to be investing overall. The bottom of the cycle is the best time to be investing, and we're probably some way from there. The property market has been showing signs of gradual correction in recent years already. Last year with COVID-19 possibly speeding it up somewhat, but there's probably still some miles to go of property correction. So what do you do in the meantime to mitigate this period of uncertainty while we wait for hopefully what will be positive structural reforms a few years from now to take the economy back into its next supercycle upswing phase? You probably best diversify offshore, looking for opportunities in regions where growth prospects and fundamentals are somewhat different. Central Europe has been one for some of the listed companies, and I get that. Right next door to the world's bigger, or one of the world's big trading blocs to the west, the European Union, of which some of those countries are becoming part of, and of course Chinese initiatives with Belt and Road to try and link up Europe to Asia looks promising for economic prospects in that region. But I think it's justified to diversify at times like this. South Africa will have to go through this process first, this political process, this policy process, before it gets to better long-term economic times and better long-term property times. It will not only require structural reforms, but it also needs to find its next big competitive advantage. I believe that we're overlooking a very important stabilizing factor in this country, and that is that we're a services-dominated economy, not a mining-dominated economy anymore. Now, what's the significance of that? Well, the significance, I believe, is that when the pressures on governments mount from private sectors, from various interest groups, lobby groups, to implement policy, a services-dominated economy demands a very different behavior from a government to certain mining-dominated economies, for instance, oil-dominated economies in the Middle East. Mining can often take place, can carry on taking place amidst even civil wars. We saw that in Angola back in the 1970s, 1980s. When you get into total chaos in a services-dominated economy, there's no value under the ground. The skills leave and the economy collapses quite quickly. It's very sensitive to volatility, to unrest, to turbulence. So I've sketched a volatile picture, but I do try to sketch a picture with hope because I believe there is hope. These super cycles come and these super cycles go. And they are long, and the volatile periods can be long too. I think that during such a volatile period, it's not without its uncertainties. Diversification globally is strongly justified.
Now on to our property panel. We've got a range of experts for you from Central and Eastern Europe to give you insights, particularly into this field, this very exciting, fast-growing field of logistics and retail. And as the world has expanded and slowed down and flexed and changed, the real opportunity has become home deliveries and everything from food to absolutely anything you can imagine that you can buy online. And that needs good logistics. We're going to look at those opportunities in Eastern and Central Europe. Now, Irina Negoita is the co-founder of Investment Report. She's about to publish a brand new report, so we'll get some top insights on that one. Also, the Chief Executive of Nepi Rockcastle, that is Alex Morar, will be joining us. Maciej Tujinsky, he is the Managing Director of Fortress REIT in Eastern Europe, so we look forward to catching up with him. And Brian Jardine, the Managing Partner of Wolf Ties in Romania, which is a remarkable part of the world if you've not been there. Rina, let's start with you, if you like. You've got your upcoming investment report. I'd like to know all of the top secrets before anybody else, please.
Thank you very much. Good morning, Bruce. It is a pleasure to be here as part of this panel. So indeed, my name is Irina Negoita. I'm co-founder of Investment Reports, and we do gradual studies on Central and Eastern European countries on real estate and energy. Our latest report focused on Romania and Poland, which is why my answer will also focus primarily on these two countries, and I'd be more than happy to give you the scoop. So in terms of opportunities, first and foremost, Romania and Poland are really the two most populous countries of Central and Eastern Europe. So it's really a massive opportunity there when you think about retail, when you think about residential, and really it spans throughout the whole field of real estate. Also, these two countries, they're democratic, rule-abiding countries. There is a perceived risk there and a sense of corruption that's coming from the past, but that's really more about perception than reality, and it's very much on the decline. And also in 2019, the World Bank promoted Romania to a high-income country, so they're doing pretty well. If we look at real estate specifically, we need to look a bit at transaction values. So 2020 in Romania, obviously on the back of things coming from the past, amounted to just over nearly 1 billion euro, which sounds like a lot unless you compare it to Poland, which, being the biggest country in Central and Eastern Europe, had more than half of the region's 10 billion euro of transactions. Also, it's quite symbolic that Poland at the moment is building not Central and Eastern Europe, but Europe's tallest tower, Warsaw, which is going to be finished this year, 310 meters. It's quite pretty, actually. Really, if we're looking at Central and Eastern Europe, and these two countries specifically, the name of the game are the yields. So you get really high yields, and you get what we would call manageable risk. To put it specifically, just without inundating you with numbers, if we're looking at logistics, Romania has a yield of 8%, which is not too far away from Poland's 5.75. And if we're looking at retail, Romania is at 7.25% and Poland is at 5.25. So to put this into perspective, it's on average, it's double the yields in Western Europe.
Good. Irina, you've given us a lovely picture. I remember having a conversation probably 2 years ago now with the late Mark Wayner, South African property entrepreneur, big fan of Eastern Europe, a huge fan of Poland. And he invited me to go on a trip to Poland with him because he wanted to show off Poland. He wanted to invite politicians and stockbrokers and analysts to look at the Polish miracle. And that was 20 years of unbroken growth. Now, clearly, COVID-19 has wrought havoc with economies around the world, and no doubt Central and Eastern Europe has not escaped that. Have we seen a recovery come through or not yet?
Well, yeah, you're completely right. First of all, Poland has had an incredible 2 decades. We called it the phoenix that rose through the ashes. If we're talking about real estate, we know that this Warsaw, for example, was pretty much obliterating during the war, and since then they've had one of the most impressive construction and also economic recoveries in the world. In terms of, so if you're looking at GDP growth, first of all, Poland was the most resilient market even during the 2008 crisis, and both Romania and Poland are among the countries with the highest GDP recovery at the moment. Of course, we have to take it sector by sector. So in real estate, for obvious reasons, the residential and the industrial sectors have been absolutely booming. Poland has a very effervescent industrial market. We're talking about more than 20 million square meters of warehouses built on plots of lands, like you put it. So yeah, that's really doing well. Obviously, retail has taken a hit, not just in this part of the world, but all over the place, and it's kind of reinventing itself. So more boutique style shops are showing up, and places with street access at the detriment of the larger overcrowded malls. But by and large, yes, the recovery is going pretty good, and also we're dealing with of challenges. So Romania, for instance, has a big challenge on infrastructure, but there's more money coming in for that from the EU, and also there's more attention from the national government on this fact. And Poland has the Polish deal, which is meant to help economic recovery in general, but has a bit of that dedicated specifically to real estate.
You've certainly whet our appetite. Irina, thank you very much. That was a lovely summary of a vibrant and exciting part of the world that perhaps many investors are a little bit concerned about considering COVID-19. But Alex Marat, Chief Executive of NEPI Rockcastle, when we look at this recovery, are you yet confident to start talking about a post-pandemic environment? Are we seeing lots of Polish people and Romanian people queuing up for vaccines? Do we get a sense of Irina's optimism for the future?
I think there's 2 different answers to the 2 parts of your question. So the good part is that people are back in our shopping centers, at least from a spending part. As far as queuing up for vaccines, I would say that the recent significant decrease in case rate, which has gotten extremely low, has resulted in people's reluctance to get the readily available vaccines in our countries. So I would say it is early to say that that we're post-pandemic, but from a customer behavior point of view, it certainly feels that way.
Potentially risky, of course. So I mean, the warning here is that, potentially not quite out of the woods yet, but that is usually when better investment opportunities present themselves. From an investment point of view, I mean, what is the market's approach to the stage of the pandemic in which we're in? What are the valuations looking like?
So our own valuations as at the year end were little impacted, only a couple of percentage points. We don't expect much more or any further impact now, especially as things are looking up as we speak. It remains to be seen what happens in the fall. Yeah, so you are now in the winter. We are in the summer, and everything is nice and well. What I can tell you is that overall the shopping centers have gone through a number of a number of closings and reopenings. So back in March, April, we had a low point of 58% operational GLA. We are now at 100% with very little capacity restrictions. So on some things like entertainment or restaurants, some have only 70% of capacity or so on. But the turnovers that we're achieving now are pretty much back at 2019 levels, although the footfall is still a bit lower. So the basket has increased.
Maciej, talk to me about the explosion of warehouses. Talk to me about the explosion in the opportunity when it comes to logistics. Because, yes, people are going back to the malls, but there is a hesitancy in terms of vaccines. One gets the sense that the real explosion that we've seen in terms of home delivery is something that, may have peaked, but certainly it'll settle at a higher level than it was before the pandemic. And as a result of that, this warehousing space, this logistics space is going to be increasingly necessary. Talk to me about how that has expanded over the last 18 months, 2 years perhaps.
Well, thank you, Bruce. Thank you for this question, because there is a lot of discussion about the internet and e-commerce boosting the growth. But it's only one part of the story. The second part is that the process of nearshoring of part of the industrial activities is also boosting the further growth and further demand for warehouse space to be delivered. And you also have to add into it for the CEE countries that there was an undersupply of a warehouse space, and countries are catching up quite quickly, building the modern warehouses, allowing for better distribution of goods, following the growth in the infrastructure region. So there are at least three main components which are attracting tenants, and also following that the investors, which are actually speaking with their checkbooks. And as far as what Alex has been saying about the slight correction in the valuations in the warehouse sector, you did not see it at all. In fact, the correction was that the yields even tightened, because of the investors' appetite, and because we see the growth in demand, we see the potential growth in the rental rates following this demand as well, and that sector presents itself very rosy, if I may say so.
What's a checkbook? I mean, I remember something. Anyway, I showed my kids a checkbook a while back. I've got an old one in the back of my cupboard, and they thought it was magical. You can invent money out of nothing. I said, you haven't seen cryptocurrency yet. Anyway, on to other issues when it comes to what is going on in the world. I mean, feels a little bit of a risk here, Maciej. I mean, help me, please. Whenever there's an opportunity in an environment, lots of people leap onto the opportunity, and quite often you see an oversupply, and it becomes a bit like a piece of elastic that stretches and stretches and stretches, and then either snaps or comes back a little bit. Are we seeing lots and lots of development? How much of an oversupply risk is that?
Well, you're correct. There is always a risk of oversupply, but you have to also remember that the, let's say, the production period of a typical warehouse building is rather short. Speculative development is limited. The financing, which is being provided mostly by mortgage lenders, the banks, the insurance companies, is not supportive of speculative development in a sense that there are no tenants pre-agreed for a particular project. Therefore, this is being kept, I think, under a reasonable control. But I think, as with every market, sooner or later, there will come a correction. That correction will come in certain areas, and that correction, or let's say a higher vacancy rates, may pop up in the older stock, a bit more obsolete, or the stock where the infrastructure grew in different regions. And that might be a cause for some concern. Therefore, it's very important to observe particulars about each project where you're investing, make careful decision based on the real plans of the infrastructure, and try to listen to the tenants and to the agents, which are frequently representing the tenants, and go for the long-term leases, which are basically providing a very stable base for investment.
What is the property life cycle like? I mean, when we look, you talk about obsolescence. How long do you have in sort of Central and Eastern Europe in terms of being able to extract value from a particular warehouse asset?
Well, Bruce, actually, we haven't seen this cycle finish yet, so it's very, very hard to say. But one can imagine that with the technological advancement, with robotics being more and more used inside the warehouses, with higher utilization of electric vehicles, with the prediction of the self-driving trucks being implemented at a certain stage, this will be a cycle-changing event. So you have to try to estimate what is the next big hype to equip your warehouse to be capable of being either upgraded or being equipped from the day one with the new features. Others may suffer, but we haven't seen the end of the cycle yet. So difficult.
Thank you much. I mean, Brian Jardine, the opportunity as you see it. You're in Romania, the home of Ursus beer and other delights. Give me a sense of it, please, from your perspective.
I'm actually a U.S. trained lawyer, but I've been living and working in the region for the last 25 years. So I bring a little bit of a cultural perspective as well as a little bit of a historical perspective to the developments over that period. I think if you look at the Romanian, primarily Romania, we have, as I said, experience with Wolf Tice throughout the region, but my own background is primarily Romanian focused. What you've seen is, as you probably gleaned from the discussion here, is really tremendous development, particularly since Romania acceded to the European Union in 2007. Of course, we took a back step like everybody else with the crisis in 08-09. But the country's really emerged. We've seen actually a transition of the type of investor coming into the region. I always say in the past, it was sort of these cowboys who were coming in and looking for a fast buck. What we're seeing now is more institutional money, more serious money. As a lawyer, what we're seeing is companies that are more adherent to corporate governance, proper controls, conducting business in an appropriate fashion. And the laws have reflected that as well. A lot of people say the biggest advantage for countries getting into the EU, like Romania, was that more funds were available, institutional or EU funds and such. But as a lawyer, maybe I'm biased. I think what it brought was rule of law. It's brought alignment of the legislation to Brussels. It's brought uniformity, and I think Irina mentioned, there's a risk perception versus a risk reality. I always tell my investors or clients that if you look at the risk perception, it's much actually greater than the risk reality, because we do have court system that functions. We have recourse to Brussels or Strasbourg if the investor really feels like they're getting home courted on some of these issues. Unlike perhaps you maybe get larger returns if you invest in sub-Saharan African countries, but you may not have that rule of law or protection of the court system. So I think this typically gives investors some comfort as we emerge into a mature economy now. People say the biggest advantage for countries getting into the EU, like Romania, was that more funds were available, institutional or EU funds and such. But as a lawyer, maybe I'm biased. I think what it brought was rule of law. It's brought alignment of the legislation to Brussels. It's brought uniformity, and I think Irina mentioned, there's a risk perception versus a risk reality. I always tell my investors or clients that if you look at the risk perception, it's much actually greater than the risk reality, because we do have court system that functions. We have recourse to Brussels or Strasbourg. Yeah, I think that's right, Bruce. I think also if you look at the quality, again, you're talking about private equity funds and institutions that are investing. They require, for purposes of, many of these are publicly traded, they have to be transparent, and they have to know when we conduct our diligence now, it's not just a diligence on the normal sorts of issues, but we also look at other aspects like data protection. We look at things like ESG, environmental social governance. We were fortunate, Wolf Tice, just 2 months ago, we advised one of the large banks here, Raiffeisen Bank, on the first ever green bond issue, almost 300 million euros. And I think that we're seeing more and more the investor flow coming into companies that are perceived to comply with these sorts of ESG requirements. Moreover, with the post-COVID recovery, in response to your prior question, we are seeing resiliency funds and other funds which are becoming available now, and how these may be able to kickstart the economy remains to be seen, but it's clear that they're going to be looking and preferring investments in these sorts of companies that are adhering to proper governance and ESG standards. So it's an exciting time. The other big driver, of course, is now we've achieved the 2020 targets, and we're looking ahead to 2030 with the European Green Deal. We're seeing a resurgence of renewable energy projects, which also may be interesting for your listeners because they implicate investments in land, they implicate a connection to the grid and production of power, and feeding some of these large industrial consumers and warehouses and such. We're seeing more rooftop solar and things of this nature. So again, it's an interesting time. I think generally across the board, if you look at the region, it's matured. And I think any investors coming from South Africa would be comforted to see how much the investor environment has improved in the last decade.
Irina, we get the sense that policymakers across the region and in national governments as well are very much on the same page as developers, are very much on the same page as investors. It feels quite a comfortable, dare I say it, space to be right now.
You do dare say that. I would completely agree with you. We've had our issues. So in terms of policymakers, in terms of our government, Romania has changed politicians more frequently than some Hollywood star changed spouses. So we've had our issues. Somehow things kept moving forward, but now we have a government for 4 years. Things are becoming more stable. They do have their own vision in terms of real estate, and things are moving forward. One thing that's interesting to mention, I think, is also the progress that's been made on the REIT legislation. So both Romania and Poland have some interesting advances here. Poland has been playing yo-yo with the whole idea. They've been trying to pass a REIT legislation since 2016, but there were some concerns. So Poland is a bit atypical because they have 95% foreign investors. So if you want to know how welcoming they are, the answer is very. But they are trying to get more local people in, so they just wanted to protect their money and make sure it was safe. And now they're starting to feel like REITs are in fact safe. And they're at the point where they're closer to passing the legislation. They released an act in April. They're setting up an interministerial team. So it really looks like things are moving forward. And in Romania, the local association and the industry is also pushing for this. And in general, both of the local real estate associations that we spoke to in both countries are saying, look, things are not perfect, but we're definitely being listened to. There's a platform for conversation. In Poland, in fact, their real estate association said that they put their print on about 80% of the legislation that does get passed as related to real estate. And people do seem like they're generally they want things to move forward, because it's about the places where we work, we live, we shop. There's money there. There's nearshoring coming from Asia back into Europe, more factories. Going back to your earlier question about a potential oversupply, it does still seem like demand is greater than the supply, and that we are looking at a general growth, especially as, fingers crossed, the infrastructure in Romania is also improving, which the authorities do say is currently a priority on their agenda.
Good, thank you, Irina. Alex Morale, just talk to me about how you are positioned within these markets. Do you see yourselves as a defensive play in a growth market?
I wouldn't say defensive, because I think we're quite active, if not aggressive, but we are in the position we are due to a strategy of focusing on dominant assets. So we are very happy to be weathering this storm from the position which we're in. I think our balance sheet speaks for itself, and the assets that we have, being the better ones in the various catchment areas, have retained more of the customer footfall than secondary type assets. So that's it in a nutshell.
Great, Matic. I mean, nobody went into the Euros wanting to lose. Unfortunately, there are winners and losers. Why, from your view, will Fortress be the winners in your region?
Well, Fortress will definitely be a winner, and I will make sure to that personally, of course. But I think, it's about experience that Fortress brings, being the largest owner of the warehouse space in South Africa, and being also equipped with knowledge from, even land sourcing, development, then operation, leasing, property management, all those functions we have internal, and we are bringing this knowledge to the market. We are very careful in selecting the projects in which we intend to invest in. We try to be careful about both the locations and about the sizes, the accessibility, and what I have even previously said, we are looking very much into the technical side, and we want to be on the top of the game regarding all technical advancements, so to really keep our portfolio answering the needs of our clients in the future as well. And that's what should assure our success.
Brian Jardine, I mean, you're the lawyer, you look at risks, you look at opportunities, you look at the law, you look at the environment, and you assess whether or not the environment is suitable for investment. You're there, clearly you believe it is. On a balance of risk and probability, what do you see as the big risk opportunity balance, if you like, over the next decade in Poland and Romania? We'll wrap up with you.
Yeah, I think in both countries, in Poland and Romania, the key is that, that they need to remain attractive for foreign investors. And in this regard, I mean that the legislation needs to remain stable. It needs to remain coherent. We have seen, for example, in Romania, recently there was some legislation introduced which would restrict foreign direct ownership in agricultural land. And this was challenged because it was perceived as a step backward. In particular, there was concern that it was violating certain EU standards in terms of allowing foreign direct investment. It was discriminatory. There has been some modification of that law now. It does establish certain preemption rights for, in terms of a priority, which can dissuade foreign investors. I know in other countries in the region, there are restrictions on, for example, using agricultural land or taking agricultural land out of the circuit for purposes of renewable energy projects or commercial warehousing projects and such. So I think there has to be a balance between, and you'll probably see increasingly a tension between this desire to attract foreign investment and some some perception that we don't want too much of the economy to get into the hands of foreigners. This has been also reflected in new legislation sweeping throughout the region post-COVID, restricting foreign direct investment and requiring any investment that is in sectors that are perceived to be critical industries or critical technologies to go through an additional layer of screening. And again, concerns that might give rise to nascent nationalism to restrict foreign investment. Although I think that in some instances, particularly in areas like telecommunications and energy, it is important to make sure that those critical sectors are being maintained by in the hands perhaps of the local companies. And interestingly, this legislation is not aligned, even though it's affecting all countries in the EU. So it's not like there's one law in Brussels. So for investors looking at Poland or looking at Romania, they have to also consider, under this new legislation, do we need to clear any kind of foreign direct investment, FDI screening hurdles?
Yeah, as somebody who lives in Romania, as somebody who's watched Romania evolve since the end of the Berlin Wall, I mean, just give me a sense of how you feel about the future.
Thank you very much, Bruce. So in a nutshell, I have experienced Romania evolve over the past decades. I have to admit that I spent a lot of the last decade and a half living in the States and Asia. So I think that in a way that actually gives me a better perspective on how the country has changed, having seen it with pockets of a few months spread out in between. And it really is a completely different ballgame at this point in time. In the 90s, Romania had no skyline. It had no major real estate developments. It was a bit of a Wild West. And now we're really at a point where we have a central business district. And really we're at a very comparable level of development, I would say, particularly in the capital city with Western Europe or some of the leading global capitals. We do have to make a differentiation between the capital, though, and some of the other areas. So Poland, for example, has a very robust secondary market in terms of secondary cities and real estate developments there. In Romania, we only have 40% of people living in cities compared to the 65% European average, which means that there is a massive potential for the development of metropolitan hubs. And it also means that you do have this contrast between the cities and the rural environments where there's so much opportunity from development, from infrastructure to better shopping centers, to so much that still needs to and has starting to be done. So all in all, I would say, especially with the technological advancement and digitalization, which Romania has been taking a lead on with robotics and other industries finding their own feet as opposed to just being outsourced, I would say that we can expect a very, very fast pace of development, and it's a pleasant environment to be in as a citizen, just because over the next couple of years we expect so much more to happen.
Irina, thank you very much indeed. Alex Morar, your perspective, please, as we wrap up this morning.
Okay, so my overall view is that we are operating in a very strong market, so the very high growth market. The whole of CEE is very attractive, with Poland and Romania being the largest markets in this region. This evidently means high opportunity for companies like ours, and I would say that we need to focus on the final customer, what they want, whatever that customer may be. In our case, the final shopper. In other cases, tenants and so on. Providing what they want and adapting to these needs, which lately are convenience and safety, should be a key to success.
And then, Maciej, to you. You get the last word on our panel today. How confident are you about this environment, this region, give it a decade?
I'm highly confident, Bruce. When you take a look at CEE as a whole, we have about over 100 million inhabitants with a great potential. This is still a young population. Many countries have highly educated percentage of their workforce speaking many languages, and you see the growth. So even those global phenomena such as COVID-19, they are impacting economies all over. but I have a strong feeling that CEE economies are recovering much faster and much quicker and are easier in a way to adapt to the new circumstances, yet they are within the EU legal framework, which provides a lot of safety for investors from the legal point of view. And that should continue for the foreseeable future. And I'm quite sure of that. Observing also the nearshoring which is taking place. I'm very, very fond of the development in the warehouse sector and further growth potential which investors can benefit from.
Panel, thank you so much for your contributions today. Really, really valuable. Thank you for your insights. Thank you for your wisdom. Thank you for your personal experiences as well. And no webinar is complete without everybody waving goodbye. So we have to wave because that apparently is the new farewell. But panel, thank you very much indeed. Well, I hope you've enjoyed the morning. I've certainly found it fascinating as somebody who has been to what Irina describes as the wild west of Romania, to Transylvania, and seeing the huge contrast between town and country in that part of the world. Hearing about these new developments of the last decade or so is certainly very, very exciting. It's the next decade that you are concerned about, of course, and that is the investment decade. Do you buy the opportunity that is presented by property and logistics in Eastern Europe? I certainly hope that today has helped clarify your mind and your decision making around that process. On behalf of Fortress REIT, who have invited you here today, thank you very much for joining us. And until next time, have a very good and productive day. Bye-bye.